Thank you, Dishan. Yes, so I'll first take you through what are the new taxes that have come to play and how it will affect your investments. So the taxes that really impact on your investment returns or investment income are mainly in four types. And number one is withholding tax, which came into effect from 1st of January this year. And number two is personal income tax, three, capital gains tax, and number four is the dividend tax. So next slide, we'll go into a little bit more detail as to how these taxes actually work. So withholding tax is applicable for interest income realized on fixed income instruments. So when I say the interest income realized, it's very important to note the word realized, which means that it's not about all income, but the income that you receive to your hand, or rather, as an example, if you receive monthly interest income from any of your investments, that is a bank deposit, a financial company deposit, or even a unit trust investment that you receive on a monthly basis, then this tax will be applicable for you. So let's talk about the tax rate. It's 5%, which is deducted at source at the point of realization. Again, you have to receive this income to your hand. And let's say you have invested or made an investment, a fixed deposit in 2020, and it's maturing in 2023. You will be applicable or liable to pay the withholding tax rate at the prevailing current income WHD rates. The exemptions for withholding tax is treasury bills, bonds, and equities. So if you look at an example, let's take a very simple example of you're depositing 1 million rupees. And if we assume that the bank will pay you 25% for this particular deposit for 1 year, which means that you will end up earning around 250,000 rupees as interest on maturity prior to the tax. And the result, when the WHT is applied, that means the net of taxes, your take home will be 237,500. Next slide, please. So number two is personal income tax. This is applicable for any Sri Lankan individual who's residing in Sri Lanka and who earns income through various means, that is employment or interest or investment income. Again, equities are exempted, and tax rate, or there's a slab related tax structure which is applicable based on which category the individual falls into. This includes salaries as well as investment income. So the first 100,000 is exempt, or in other words, 1.2 million annually per annum is exempt. And afterwards, every tax slab up until 308,000 is taxed at 6%, 12%, 18, 24, 30, and the highest at 36%. Next slide, please. So if we look at an example, so we've taken three scenarios to show you how this will impact your monthly salaried income or any other investment income. The first example that we have taken here is to assume an individual who's earning a salary of 500,000 a month. So if you look at his entire salary, the first 100,000 will be completely exempt from taxes, and from 100,000 to 141,600, he'll be liable for a 6% tax component, which will amount to 2,500 rupees. And 141,600 to 183,200, it will be at 12%, that will amount to 5,000 rupees, and so on and so forth at 18%, 7,500, 24, 10,000, 30, 12,500, and finally, the remaining 192,000 will be taxed at 36%, which means 69,000, and all of this accumulated will amount to around 106,500. Which means that if it's an individual, his or her take home will be 393,500. Next slide, please. So the next scenario we have taken is an individual again who earns 500,000 a month. But in this scenario, he or she also earns a treasury bond coupon of 250,000 a month. One special thing to note here is that treasury bills and bonds are withholding tax exempt. There is no WHT component for government securities. So if you look at the total income of this particular individual, it will be around 750,000 because we have added the coupon payment of a treasury bond as well. Again, it will be treatment when it comes to the tax and tax slabs 6, 12, 18, 24, and 30. Where it actually changes is in the final row. If you can see, comparatively, previously the individual was only having 192,000 that was taxed at 36%. But here, because the 250,000 coupon payment has been added, his final component increases to 442,000 at 36%, which means the tax component, or rather the amount, is 159,000. This amounts to a total income tax payable of 196,500, which is the increase from the previous example. But one has to also know this is also because of the coupon payment that he or she received on a monthly basis. Go to the third slide, please. So the scenario number 3, like I told you earlier, except for government securities and equities, any other fixed income instrument is taxable when it comes to WHT. So let's assume an individual has a 100,000 monthly salary and also earns a bank deposit interest of 250,000 a month, which is subject to WHT. How the tax treatment would work in instance like that? So again, 100,000 exempt, and we come to the final slab at 36%. This particular individual will be taxed. The final slab would be 442,000, that is taxed at 36%, and 159,000 would be the tax component for the final slab, and your personal income tax accumulated figure will be 190,500. But what will come in excess, or rather to be slightly different, not excess, slightly different, would be the WHT component. Here there will be a 5% WHT component on your return that you get from your bank deposit, because the bank will deduct that 5% and only give you the monthly interest. So it will be 12,500. But the impact would be identical, because with the withholding tax, it essentially becomes a tax credit where you can set off your total income tax liability and deduct the withholding tax component, and the impact, or other take-home amount, will be identical for an individual who would have either invested in a bank deposit and who takes a monthly interest, compared to an individual who has invested in a treasury bond who takes a coupon payment. The impact would be identical. Next slide, please. So the third type of tax that we will talk about when it comes to investments is capital gains tax. So it's applicable for capital gains on realization of investment assets, which includes property, T1, T-bills, and capital gains when it comes to trading of those assets. Which are excluded are equities, and if capital gains of trading is less than 50,000 a month or less than 600,000 a year. The tax rate is 10% for individuals and 30% for corporate. The cost consideration, or how a property will be valued, is for all the properties, the cost will be treated as the market value of the asset as at 30th September 2017. And if you look at an example for capital gains tax, is if an individual buys a house for 20 million in 2019 and sells it for 30 million in 2023, very simply put, it's a 10 million gain. And out of that, 10% means the individual will have to pay rupees 1 million in capital gains taxes. Next slide, please. So if you look at the final component when it comes to investment-related taxes, it's the dividend tax. The treatment for this is very similar to WHT, and why I say that is it's applicable again on dividends on shares and equity. So if you take an example, let's say it's the dividend is declared for dialogue shares, and you hold share 1,000 shares, and the dividend is declared for rupees 1 rupee and 50 cents per share. The total dividend will be around 1,500 rupees, and once 15% of that tax is withheld, or dividend tax is withheld, the total dividend tax that has been reduced will be 225 rupees, and your take home would be 1,275. So it's who will be withholding and paying is the company. In this instance, it will be Dialog who will be withholding that particular tax component and paying it for the shareholders. Next slide, please. So after I explained to you about the taxes that are applicable, then we'll look at what CAL's viewpoint in as to see if the taxes are here to stay, and also to look at what are the investment instruments available to ensure that you optimize your investment returns. And for that, I'll hand it over to Udeeshan.
Thank you, Shehana. Before I run through my slides, if you have any questions, feel free to drop in on the chat box, and we would be happy to respond to the questions during the Q&A session. To summarize in terms of what some of the things that Shehana touched upon, the critical things are that A, you will only have to pay taxes when the investment return is realized. So if an investment return is just accruing an instrument, you don't have to pay taxes on that particular year. So you only pay taxes on your returns if you have taken it as cash. Right? So that's the key concept and the most important concept that we have to keep in mind in terms of how we can use this realization concept to optimize our tax returns. Right? The other important things are that when it comes to personal taxes, obviously your maximum threshold is going to about 36%, but the 5% can be withheld, and you can offset it against the personal tax liability. The other important thing is the only instrument which is kind of exempt from all the taxes are equities or investing in the share market, where capital gains are not taxed. And also your WHT is also exempt from the transactions. To look at, okay, are these taxes here to stay? Right? So now if you look at the new tax brackets, the highest tax brackets have increased to about 36% from about 18% a year ago. Right? Does Sri Lanka have to maintain these kind of rates for the longest period of time? Right? So couple of observations. So if you look at the current income tax structure, the main reason why we have to push, or the government had to push the rates to about 36% on the higher end, is because there is a few number of people paying taxes at the moment. Right? So to put numbers into perspective, in 2021, only 4% of the employed population paid their personal income taxes, right? So this is inclusive of employment income and so on. Only 4% of the taxpayers, only 4 payers of the employed population paid taxes during the year. This is in comparison to 17.5% of the population, which paid their taxes back in 2019, when it was automatically deducted from your salaries. In most of the cases, it was employment taxes, which was deducted at source. Right? But with the new taxes which came into play from 1st of January this year, we are going back to the old tax regime, where most of the taxes are going to be deducted at source. When I say most of the taxes, your employment taxes. So starting from this month, when you see your salaries, the government is going to deduct your taxes and send your salaries back. Right? Also, in terms of your investment income, since most of the population invest in the typical bank deposit kind of products, even on your interest income, you will be deducted the 5% before you get the net interest to your hand. Right? So automatically the bank will deduct the interest, and the remaining proceeds will only come to your hand. This is different to the previous regime, where you have to declare your entire income, whether it being employment income or interest income, and you have to mention which bracket you fall into and pay that particular tax. Here, the difference is now the main taxes like employment income tax and the WHT tax are going to be deducted by the withholding agents or at source. The bank will deduct for you in terms of the WHT on interest, and in terms of your employment income, your employer is going to deduct the salary, the taxes from your salary, and send that the balance to your account. Right? So the only way that there is a possibility that taxes can come down in the near future is if the government can improve its collections. Right? So ideally, in an ideal world, 100% of or almost 100% of the employed population should be paying taxes, but obviously there will be X percentage of the population which is falling below the 100,000 threshold. But if you look at our peer countries, roughly on average, out of the employed population, 30 to 60% roughly pay taxes. So even in 2019, the 17.5% population which paid taxes was a very low amount compared to what it should have been. So what we feel is if the inland revenue really goes after people who are not paying taxes, if they can start going back behind employment income or even investment income by tracking the sources, which they are planning to do, they will be able to increase their collections at least by 70%. Right? So if they are able to increase their collections by 70%, they can afford to reduce the tax rates from the current 36% on the higher bracket down to about 24-25%. Right? So there is a possibility that they can bring down the tax rates in about 2 years or 3 years when the government has improved on its collections. Right? So as you all know, the inland revenue is working on new mechanisms in terms of tracking down people. For example, one of the key things that they've announced is that going forward, and it has not still been implemented, that every deposit or even any financial instrument that you have, the NIC number should be part of your bank deposit number or so on. So for example, in the future, if you have a particular bank deposit, it will start with your particular NIC number, 90, whatever. And the inland revenue should be able to find, if they put in the NIC number, they should be able to see all your investment related income, right? So that's the ultimate result that they want to get, right? But at the moment, they are still not there. Right? So at the moment, it's difficult for them to track, but eventually they're going to get there, right? So what you have to efficiently do is try to start paying and also look at efficiently managing the tax without looking at not paying the tax at all. Right? So if the government can improve its collection from 17.5% to 30%, where they can collect taxes from 30% of the people who pay, who are employed, they can raise the same amount of money at 24% maximum rates compared to the 36% rates which are there right now. Right? So there is still a possibility that in 2 years or 3 years time, these kind of tax rate can come down. Second is when your interest costs, because if you know, roughly about 70-75% of government's revenue right now goes into interest expense. Right? Given that they've been paying roughly about 30% interest on government securities, their interest costs are substantially increased. Right? So with interest rates coming down, if there is an IMF program which comes into play, treasury bills which are raised at 30% now, right now, or 28 to 30% right now, can fall below even 20%, right? Which effectively will reduce the government's interest cost, and which will mean that effectively government can afford to reduce the tax rate because their costs will kind of reduce. Right? So there is a possibility that these kind of 36% tax rates on the higher end is likely to reduce in 2-3 years time, right? And the range that we're looking at of 30 to 36% is the kind of tax rates that you pay in a developed country. Right? So you don't see very high rates in developing countries. So this is an abnormal rate that the government is using for the moment until they improve their collections. Right? So from our perspective, there is a likelihood chance that you can improve your collections in 2-3 years time. And by doing that, you can reduce, they can afford to bring down the tax rate in the near future.